everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate your willingness again in continued ways to allow for these more frequent updates to come to you with regards to what we see happening in the markets, what we see happening in our overall economy. And again, appreciate your time, and because I want to be respectful of it, even though this is going to be a relatively short update, I'm going to dive right in. Several things have happened since our last update, all of them noteworthy. The first is we had our midterm elections. Most of those races have been decided at this point. Still a couple of crucial ones that haven't been, and we're going to get some additional data here over the next couple of months, whether it's with regards to runoff or the final counting of ballots, and to have some more clarity on that as those numbers become more well known to us. So that's the first big item. Second big item that happened, which again was very, very expected by folks in my end of the universe, was the increase again in the overnight lending rate by the Federal Reserve by another 75 basis points, or 0.75%. Again, largely expected. The third big item that we had, though, and this just happened this past week as of the time of this recording, was a CPI number which was lighter than expected. Now, CPI stands for Consumer Price Index. You probably have heard it quite a bit here over the last several months. If you're watching any business news show or you're reading any business news periodical or newspaper, you're probably seeing the CPI index being noted quite a bit because it is the most widely used barometer of inflation. So we had a tick, or we had a print this past week of the most recent CPI number year over year, and it came down. And that's the first time that it has regressed or it has pulled back here over the last several months. And so when that happened, there was quite a bit of euphoria in the market. By euphoria, I mean we had a couple of big days back-to-back with regards to returns in the overall stock market as there was this decrease in CPI. Now, when I say decrease, let's put that in perspective. We chimed through a 9% annualized inflation rate several months ago. We had a couple months of 8% annualized inflation year over year, and then this one went from 8.2 to 7.7 here over the course of the last month, looking over the last year. So in terms of looking at not just a month's worth of experience, but a full year's worth of experience in that data point there. So 8.2% annualized to 7.7. Now, a half of 1%, usually kind of a big deal. However, when you're up there in the eights as far as percentages of inflation are concerned, going from 8.2 to 7.7, I don't think any of us are going to, in material ways, feel the benefit of that, if you will, at the grocery store or the gas pump, which is where we most often feel the effects of inflation. But it is a different course from where we've been, meaning it was notably hot, notably higher than any kind of reasonable norm would expect. And so coming in that other direction, I would offer up to you, we got a little bit of a relief rally, in our equity markets, stock markets, and also in our bond markets here over the course of the last week. So I think it was just pleasing and maybe a little bit unexpected that there was going to be a downtick in inflation on this most recent reading. And so the markets really kind of took off on a relative basis. Now, still down notably for the year, so I don't want to give the impression that we have somehow rebounded back to where we were. Still notably negative for the year as measured by our most popular stock indices, but definitely a rebound off of the bottoms from where we were. As a matter of fact, if you track the NASDAQ, which just happens to be among the most volatile of our stock indexes, both positive and negative, it was positive this week over 8%. As of the time of this recording. So very, very notable. I mean, literally a year's worth of return in a week. So very, very notable in that regard, very unusual, and of course not sustainable. We say that both with regards to the upside and the downside, that's just not a normalized kind of week or what we should expect in terms of a rebound kind of week ongoing. So those three big items, again, the elections, the midterm elections, largely known at this point, but still getting some clarity with regards to final counts, which probably are going to affect the Senate the most. It looks like there has been a shift in the majority in the House, and so we're probably going to see the effects of that here over the next several months. But the Senate is still kind of neck and neck, and we're waiting to see final results there in terms of how that's going to materialize. And then the second big item with regards to where things are, Federal Reserve increasing the overnight lending rate again, almost completely predictable because of the ways in which they forecast that kind of increase coming. And then with regards to the markets, performing in such a way with regards to what has happened with regards to the CPI, or the Consumer Price Index or inflation rate, somewhat surprising this week. So what does all of that mean? Well, it means a lot of things. And you know me, I don't get too carried away on any singular data point or even a couple of data points, but attempt to put them together in some patterns so that we can determine some trends. We still have some things yet ahead of us. We still have a Federal Reserve that's going to be meeting again in December for their final meeting of the year. We're probably going to get another interest rate increase. At least that's what they have been forecasting at this point, that we're going to have another increase in our overnight lending rate in order to continue to tamper down inflation. So I anticipate that that's going to happen, which means there's still going to be quite a bit of flux in the market. Second big item that we see, and I wish I could say that we were just going to continue this parabolic move in a positive direction with regards to recovery in the stock markets. We're still going to have a lot of turbulence. You've heard me say now a number of times that I anticipate it's going to be 6, 9, even 12 months from where we are right this moment as of the time of this recording for the markets to begin to stabilize and adjust to the quote new normal. I anticipate that that's going to continue to be the case. While I would love for it to happen overnight and that we would have some kind of very quick recovery that would recuperate a lot of the losses that we've seen in our stock and bond indices and gold for that matter indices here this year in 2022 year to date, I anticipate that we're going to continue to be in a space of recovery, meaning we're going to have some big up days, probably going to have some big down days as well. So I just want to set up that expectation, not wanting to look a gift horse in the mouth or the glass half empty or any other kind of cliche with regards to what's happening, but rather just the benefit of the experience that we have in looking at where things are. Still want to see where things are going to play out. I don't expect that we're going to have that immediate kind of recovery that I know all of us wouldn't mind seeing happening. So we still have got some road to run here, and especially as we're looking into the end of the year, we're going to be looking for things like what the expectations are for our retail spending season. That tends to be a big indication about where the consumer is, meaning in terms of confidence in the economy as we get into the Christmas shopping season with more fervor as we get closer to the holiday. Again, that tends to be a good indication about their confidence level, the consumer's confidence level with where things are. And as consumer spending is between 2/3 and 3/4 of our overall economy, it's a very big deal. So we're going to be watching that very closely. Second big item that we're watching closely, and that's because when we're thinking about CPI or inflation in marking our economy and where things are, real estate, specifically residential real estate, is almost 40% of that equation. So we're watching residential real estate very, very closely right now, especially because we have mortgage rates as measured by the average 30-year fixed mortgage up over 7%. Haven't been there with any consistency for the last 20 years. So it's a very noteworthy point, and yes, it's there today, but we're really not going to understand the full effects of that. Again, as you heard me say this time frame, 3, 6, 9, 12 months from now, as that has a chance to fully matriculate through our economic system. Meaning, are there folks who are going to be making significant decisions about what they're going to buy, what they're going to sell, and the timeframes in which they're going to do it, and the expanse or the breadth in which they'll be willing to spend or sell in that space for the next number of months. So we're going to be watching that very, very closely. It's a big, big factor. Residential real estate, yes, we expect that it's going to cool down, but how much? And what is that going to mean for the overall economy in terms of expenditure and future economic growth? So those are the big things that are on our radar screen here. Well, friends, I'm going to let you go. I wanted to give you that brief update on the things that we're watching on our end of things, and not to tamper down the excitement of a very good week when it comes to overall performance in the markets, but really to put it in perspective and to make sure that we're keeping track on things in ways that are appropriate so that we can make good decisions planning-wise for what comes next. I appreciate so much of your time. If you're like me, we're into football season. It's a fun time of year for that. Unless you're a Pittsburgh Steelers fan or a Carolina Panthers fan, it's been a little bit of a challenge with regards to their performance this year. But let's stay eternally optimistic, especially as we're looking at the Thanksgiving and Christmas holidays ahead of us to enjoy those special times, I hope, for you, as we know will be for us on this end of things as well. But you know, always, 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 feel free to reach out at any time via email, via phone. You have questions. If you'd just like to chat about where things are, or if you'd like to chat about your favorite Thanksgiving traditions, I love that kind of stuff. Thanksgiving, I think, is probably my favorite holiday of the year because of how much food is involved with it. And I love the eating part of Thanksgiving, so really looking forward to that. Well, friends, again, thank you so much for your time here. Always feel free to reach out to us, and until the next time, I'll look forward to chatting with you soon.